Whole life insurance is one of the most controversial financial products in the world. Some people swear by it, calling it a powerful wealth-building tool, a financial Swiss Army knife, and a cornerstone of long-term planning. Others criticize it harshly, labeling it expensive, inefficient, and far inferior to traditional investing in stocks. So what's the truth? Is whole life insurance actually better than stocks, or is it just cleverly marketed? To answer this, we need to go beyond surface-level opinions and truly expose how whole life insurance works, where it shines, where it falls short, and how it compares to one of the greatest wealth-building tools ever created, the stock market. Today, we will talk about whole life insurance exposed, better than stocks or nah. So, before we start, make sure to hit the like button and subscribe to my channel. Let's start by understanding what whole life insurance actually is. At its core, whole life insurance is a permanent life insurance policy that provides coverage for your entire life, as long as premiums are paid. Unlike term insurance, which expires after a set number of years, whole life guarantees a death benefit no matter when you pass away. But what makes it unique is its cash value component, a portion of your premium that accumulates over time and grows at a guaranteed rate, often enhanced by dividends from the insurance company. This cash value feature is what turns whole life insurance into more than just protection. It becomes a financial asset. Over time, the cash value grows steadily, and policyholders can borrow against it, withdraw from it, or use it in various strategic ways. This is why many agents market whole life insurance as both insurance and an investment. But here's the first truth to expose. Whole life insurance is not a traditional investment like stocks. It behaves very differently, and comparing the two directly can be misleading. Now let's talk about the costs, because this is where many people are caught off guard. Whole life insurance is significantly more expensive than term life insurance. A policy that might cost $40 per month for term coverage could easily cost $400 or more for whole life. Why? Because you're not just paying for insurance, you're also funding the cash value, administrative fees, and commissions. In fact, in the early years of a policy, a large portion of your premium goes toward fees rather than building cash value. This leads to another critical truth. Whole life insurance has a slow start. In the first few years, your cash value may be much lower than the total premiums you've paid. This means if you cancel the policy early, you could lose money. It often takes 5 to 10 years, or even longer, before the policy begins to show meaningful growth. This makes whole life a long-term commitment that requires patience and a clear understanding of its structure. Now let's compare this to stocks. When you invest in the stock market, your money is typically put to work immediately. While there may be short-term fluctuations, your investment has the potential to grow much faster over time. Historically, the stock market has delivered average annual returns of around 7% to 10%. Significantly higher than the typical 3% to 5% internal returns of whole life insurance policies. This difference in returns is where the debate becomes intense. Over a 20 or 30-year period, investing in stocks can result in dramatically higher wealth accumulation compared to whole life insurance. This is why many financial experts argue that if your primary goal is to become wealthy, stocks are the superior option. The power of compounding, combined with higher returns, creates a gap that is difficult for whole life insurance to match. But here's where the conversation gets more nuanced. Whole life insurance offers something that stocks do not: guarantees. Your cash value grows predictably, regardless of market conditions. There are no crashes, no sudden losses, and no emotional roller coasters. For individuals who value stability and peace of mind, this can be incredibly appealing. In contrast, the stock market can be volatile, and not everyone has the temperament to handle its ups and downs. Another feature often highlighted by proponents of whole life insurance is the ability to borrow against your policy. This is sometimes referred to as being your own bank. You can take loans from your cash value without selling assets or triggering taxes. This can be useful for emergencies, business opportunities, or major expenses. However, it's important to understand that these loans are not free. They accrue interest, and if not managed properly, they can reduce your policy's value or even cause it to lapse. Taxes are another area where whole life insurance has an advantage. The cash value grows on a tax-deferred basis, and policy loans can often be accessed tax-free if structured correctly. Additionally, the death benefit is typically paid out to beneficiaries tax-free. These features can make whole life insurance an attractive tool for high-income individuals looking for tax-efficient strategies. However, there's an important trade-off here: liquidity. While you can access your cash value, it may take years to build up a significant amount. In contrast, investments in stocks or mutual funds can often be accessed more easily, although they may be subject to market risk and taxes. This difference can be crucial depending on your financial needs and time horizon. One of the biggest misconceptions about whole life insurance is that it is either completely good or completely bad. The reality is much more balanced. Whole life insurance is a specialized financial tool designed for specific purposes: long-term stability, estate planning, and risk management. It is not designed to maximize returns, and expecting it to outperform stocks is unrealistic. Here's another important truth that often gets overlooked. Whole life insurance rewards commitment and penalizes inconsistency. Unlike stocks, where you can start, stop, or adjust your investments relatively freely, whole life insurance requires ongoing premium payments. Missing payments or exiting early can significantly reduce its benefits. This means it works best for individuals who have stable cash flow and are committed to long-term planning. So, is whole life insurance better than stocks? The honest answer is no, if your goal is pure wealth creation. Stocks have a clear advantage in terms of growth potential, flexibility, and long-term returns. But that doesn't mean whole life insurance is useless. In fact, it can play a valuable role in a well-rounded financial plan. For example, some individuals use whole life insurance as a conservative portion of their portfolio, balancing out the risk of stocks. Others use it for estate planning, ensuring that their heirs receive a guaranteed tax-free payout. Business owners may use it for continuity planning or as collateral for loans. In these scenarios, whole life insurance serves a purpose that stocks cannot fully replace. Another important factor is behavior. Many people struggle with investing consistently. They panic during market downturns, stop contributing, or withdraw money at the wrong time. Whole life insurance, with its fixed premiums and structured design, can enforce discipline. While this doesn't increase returns, it can improve outcomes for individuals who need that structure. It's also worth noting that financial confidence plays a role. Some individuals simply sleep better knowing part of their money is in a guaranteed, stable system. That peace of mind can reduce stress and prevent impulsive financial decisions, which indirectly supports long-term success. Ultimately, the exposed truth is this: whole life insurance is not a scam, but it is often misunderstood and sometimes missold. It is not a magic wealth-building tool, nor is it inherently superior to stocks. It is simply a different type of financial instrument with its own strengths and weaknesses. The smartest approach for most people is not choosing one over the other, but understanding how to use each effectively. Stocks can drive growth and build wealth over time. Whole life insurance can provide stability, protection, and strategic advantages. Together, they can form a more balanced and resilient financial plan. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.